Now, I think the thing that the global community fears more than some kind of event in the States is the flow of capital internationally, which recently seems to have been from the developed markets towards, let's say, the less developed markets, and to some considerable degree, I suppose, towards Australia, visible in the exchange rate. And you don't want that to reverse too quickly. If that's going to reverse, you want it to reverse in a very orderly way. And financial history is full of orderly reversals, but the ones we notice are the ones that aren't so orderly. The ones that make the history books are the ones that are not orderly. So there's some concern about that, and reasonably so.
Neal, we've had nearly 6 years of these unconventional monetary policies being pursued by most of the large developed economies, and yet there's been very little growth in the real economies as opposed to financial assets. Does that say that the policies haven't actually worked?
Well, it's always a question of what is the counterfactual, what would have happened otherwise. And since no one knows, you can only make a judgment about it. And I think it's fair to say that had policies not been adopted that were as stimulative as the central banks knew how to do, things could easily have been much worse. You know, I've only been in Australia the last couple of days, and it's been regrettably too many years since the last time I visited. One thing I notice in talking to business people and journalists and public officials and all is that the trauma of the North Atlantic, the lingering memory of how awkward and difficult and painful and frightening that was, is much more intense in the States and Europe and so forth than it is down here. You know, you've had 22 years of uninterrupted economic growth. In some ways, you know, you had a good crisis, so to speak, because you had China very eager to buy the raw materials and so forth during the period of great distress in the U.S. and Europe and so forth. So it may be hard for you to appreciate just how frightening this all was.
The Fed originally said that they would start raising interest rates, or they suggested they'd start raising interest rates when unemployment got to 6.5%, but now it's 6.2%. Do you think that the Fed is now actually playing with fire by continuing to stimulate and keep rates at zero, even with unemployment where it is, and you know, the economy clearly recovering?
Well, let me, if I may, first challenge, if you will, the premise of your question. The Fed always said this was a threshold, not a target. That is to say, what they had communicated to the market and to the policy community was they would not even contemplate changing interest rates or changing policy until unemployment had reached that level. That was not to say as soon as it reaches that level we're going to change policy. It was we're not even going to think about it till then. So I don't think they've breached any promise, if you will. With respect to your the second part of your question, no, I don't think they're playing with fire. There's a degree of distress and so forth, which perhaps Chairman Yellen is more sensitive to, if you will, than some others around the world. But I have a certain sympathy for her view that until you see wages start to recoup some of the lost ground of recent years and so forth, until you see symptoms that tell you that the unemployment rate is adequate to judge the quality of economic performance and labor market performance, it's okay to take some risks on the easy side. Now, the fact that I have some sympathy for that doesn't mean that I advocate it, doesn't mean that I do anything except forecast it. I expected her to hold this view. I'm not surprised that she holds this view, and I expect her to continue to hold this view until there's enough evidence to satisfy her, and of course the committee members around her, that there really is some risk of more inflation than is desired, or some other tangible overheating of economic or financial life.